In this video, we're going to be talking about qualifying EBITDA add-backs, separating fact from fiction, what kind of EBITDA add-backs the market will and won't accept, how top firms justify and defend strategic add-backs, and towards the end, we'll be discussing a few real-world examples. So whether you're looking to buy a business, prepare your business for sale, or you're just EBITDA-curious, this is the video for you. Sharpen your pencils, pull out your notebooks, take some notes, because this is going to be a good one. Jeff, Antonio, welcome to the show.
Hey Tim, good to be here. Good to see you guys.
Very exciting topic. EBITDA
Indeed.
add-backs, separating fact from fiction. You know, I thought before we started this session here that maybe we could just define two simple terms. One is add-backs and one is EBITDA.
And I guess also people kind of say it differently. Some people go EBITDA, some people say EBITDA, mispronounce it. It's kind of a mystery sometimes, but it is an acronym. It's earnings before interest, tax, depreciation, and amortization. Very exciting stuff. And basically, it's a measure of operating profits for a business, right? Which obviously buyers are always most concerned with. And so that's why it's kind of the key financial metric for M&A transactions and most other things when we're talking about company fundamentals and financial health. The add backs or adjustments, and by the way, synonymous in this conversation today. You'll see add backs, you'll see adjustments. AEBITDA, which is short for Adjusted EBITDA, is essentially intended to kind of remove non-recurring, non-operational, and owner benefit expenses or distributions to get to more of a normalized Adjusted EBITDA number. Because again, in the context of this conversation, Tim, we're thinking about buyers and sellers, and buyers want to be able to normalize the financial picture post-transaction, and that's what the Adjusted EBITDA allows us to do when we think about add-backs and adjustments. And so, very, very important topic, one that I think some people might overlook, but I'll be honest, and Antonio will tell you the same thing. This is kind of like what it really comes down to on most deals, most transactions around the discussion we're having. So off we go.
Off we go. That's great.
Yeah.
Thanks for those definitions. We got some slides here.
Yeah, very good. So quick intro, Jeff Jones, Vice President, Growth and Capital. Been here 20 years, spend most of my time on the investment banking side of our business, and alongside Antonio as well, which he will jump in. So today specifically focused on EBITDA adjustments and add-backs and helping the audience understand what's important, what's not important, and what the expectations are heading into a potential transaction, right? So again, as I said at the top of the call, when we are trying to peg enterprise value, most M&A transactions will rely on EBITDA multiples, right? A multiple of your EBITDA as the best measure of the operating profits of the business. And so when there are adjustments or add backs to that EBITDA, which we'll get into, it matters. It represents real value, right? And so again, the intention here is to look at add backs and adjustments based on non-recurring expenses, non-operational expenses, and owner discretionary expenses, and then bring that back into the fold or remove that from the equation to get a better, real kind of normalized value for the buyer. Okay, those add backs and adjustments are sometimes accepted in the market from buyers, sometimes not. And it will be a direct impact, maybe even dollar for dollar, on your enterprise value, right? So if they're represented properly, if they're accepted, this could be meaningful. For example, if you're valued at 6 times EBITDA in terms of your LOI, for example, okay, on a trailing 12-month basis, and your add backs or adjustments are $250,000, then we're talking about $1.5 million of enterprise value if you're given full credit for those adjustments. That's a lot of money. So, these things can't be taken lightly. I think most sellers know that. And, they're trying to get as specific as possible and trying to get as much credit as possible. And the buyers are opposite, right? They're always skeptical. And they're always looking for evidence, and generally accepted add back expenses, they're pretty common. We'll talk about those. There are add backs that require stronger defense, and then there are some attempts by the seller that don't have a shot or maybe even mischaracterized, right? So these are the kind of things you have to be thinking about pre-transaction. And during the transactional conversation, in due diligence, for example, this will impact how things go. And oftentimes we see that deals can fall through based on the adjustment or add back conversation, where sellers are attempting to get credit for add backs, but the buyer's not accepting or only giving partial credit. And so that's a problem, right? Also, qualitatively, concerns around these types of things, these types of adjustments and add backs, they create cycles and potential deal fatigue or trust issues or credibility, right? So let's be reasonable here, right? Let's be rational about it. If you're a seller, the key thing is understanding what you can get, what is accepted, what's not, and going to market with that expectation. And again, there's some technical things around deal flow as well, or the deal process you should be aware of. Oftentimes, those adjusted EBITDA metrics or numbers will impact the deal, not just from a valuation perspective, but if you're dealing with a private equity fund or a financial buyer, it will often impact how they structure their deal. Cash or debt, debt and leverage will be triggered upon and applied to adjusted EBITDA. Relying on that number to, provide terms for debt, covenants for debt, it'll impact how the company might service that debt going forward. So that's why those adjustments are so important. There's a lot of things that go into it, and we'll get into some specifics. But that's kind of the general impact and meaning that we're focused on today.
I got a quick question for you here before we move on.
Yeah.
You speak with a lot of business owners on a daily basis, specifically around this topic. You both do.
Yeah.
And some of them are very sophisticated naturally. Would you say that the ad backs conversation is a big surprise? It's news by the time we get to it in an exit, or is it, they more or less have known what they've been doing and now they kind of have to fess up to some things?
Yeah, I think it's more the latter. Historically speaking, I think back in the day, it was more of a surprise, but I think now, just generally, Tim, the market is more aware. And I say market from the sell side perspective,
Right.
A bit more sophisticated and savvy because they're exposed to a lot of these conversations that they're having when they start thinking about a potential exit.
Out there. Yeah.
Correct. And I mean, whoever's listening to this, just go to ChatGPT Perplexity, type it in, prompt it, and you'll get a whole essay on what you should and should not be doing, right? And that perspective might not be accurate, but yeah, there's more access to information. So it's much less surprise these days and more about what's accepted, what's not accepted, and kind of the fight and the struggle between those two things.
Yeah, that's great. And that's why I think conversations like this are so important to shed light on that.
Indeed.
I was just on the phone with an operator that is anywhere near an exit or not running a process, not in the market. And he was sharing with me the monthly operating and financial model where they're tracking their growth, their sales, their profits. And he's keeping track on a monthly basis of ad backs, right? And that's, to me, it's the right mindset, right? You
Yes.
already. It's not very frequent to see this, but it is the right approach because you're keeping track of all sorts of profitability levers, the ones that matter to you, the ones that matter to other stakeholders, and you're aware of them and you know what impacts them. So as you get closer to that exit window, you're already sort of prepared for it.
And we'll be talking about that a lot, right? From Antonio's point, it's consistency, it's tracking. And so, again, all buyers are intensely focused on true profitability, and adjusted EBITDA and EBITDA are the measures of that. And buyers are naturally skeptical, right? The standard of proof, the burden of proof is high and resides with the seller. And so adjustments aren't going to fly unless there's clear documentation. To Antonio's point, you're tracking, it's consistent, right? Evidence is everything around those adjustments, especially if there is a trend that you can capture over time, right? It gets everybody more comfortable with how the business operates. Another point here too, and we see this all the time, right, Antonio, and you'll go through some of these examples later, but if add backs and adjustments represent a big portion of adjusted EBITDA, it's unlikely you're going to get credit for all of that, right? So if you're running a business with 5% margin or 10% margin, but the adjustments represent 9% of that 10%, well, we probably got an issue, right? And so things to consider that way when you talk about having logic and rationale and applying these things are very important. And then, the last thing I'll say is, and what I kind of said earlier, is if you come to this process with inflated or aggressive numbers around the ad backs, it's going to backfire, right? You want to be conservative with your adjustments. It'll earn you more trust. It'll be more credible. It'll just be better for the deal making process and potential buyer partners that you're talking to, and ultimately probably get you a higher valuation. So the struggle is real, but maybe not worth it to a certain extent. And that's why you do the preparation now. And that's why you track going forward. So having clean ad backs is always what we're aiming for.
We thought about showing some of the main categories of ad backs, starting from the more typical ones. So we mentioned this at the beginning, the one-time expenses, the the extraordinary expenses. So we listed some there: settlements from from a legal case, or advisory fees related to a certain initiative, relocation related to a plant, obviously financing costs for a transaction. Those are typical examples. The other big category are the owner discretionary expenses. Oftentimes, especially in small, medium businesses, the personal expenses flow in the business. The business and the family is one thing, for tax mitigation purposes, oftentimes are driving those expenses to flow into the company accounts. They need to be separated when we do the add backs. Now, on the owner compensation, you'll see that we have it in both columns, both in the typically accepted and rejected, because the owner compensation per se is not an add back, but when it is above market rate, we can consider that exceeding part as an add back, right? We normalize the compensation. Other times there are multiple owners, and we'll see some real world examples where in a scenario post-acquisition, some of the management or owner compensation can be considered an add back because there will be no replacement of one or more individuals. Another big one are the rent adjustments. Oftentimes there are related parties where a building or facility is leased to or by a related company or by another company owned by the owner. Oftentimes those rents and leases are not market rents, so they need to be normalized, which could be plus or minus, right, depending on that. And then maybe, Jeff, you want to comment on the last one, services in exchange for equity, which we saw recently on a deal.
Yeah, and this is interesting, and sometimes that does happen specifically for services company, and where there are times, depending on the client or end client in that situation, that you're taking cash and equity as compensation that can be recognized as revenue, and the equity portion of that can come back as an add back or as an adjustment, when the time is there for an exit. So these kinds of things, again, need to be tracked. Now, there's some complexity around that, of course, in terms of marking value at the time and over time, and then the buyer has to get very comfortable with what that equity represents, what type of business, and is it a going concern, and all of those things. But and you will, we've kind of researched this, talking to CPA attorneys, tax attorneys, and CPA friends, that this will be accepted if it makes sense to do so. So something to consider too, if you have a business that does potentially get paid in cash and equity over time.
I think that's an excellent bullet point there, because I've heard that plenty of times. I know in my own businesses I've done plenty of that, so it's good to see there. And also just wanted to make one point earlier about the co-mingling of expenses. We ran a poll on this when we did this live last week, and it was like the number one co-mingled expense was like family vacations or global trips or private planes and all those kinds of things.
Again, perfectly fine for a business owner, right? To pass through personal expenses, which is a huge advantage to do so, as Antonio mentioned. Just make sure everything is clean, tracked. There's evidence of it. Use one credit card, right? And just make it easy. And let's bring it back at transaction time. No problem. This is kind of the key to any due diligence process when you're thinking about selling a business. Historically, and of course going forward, this has usually been a buy side or applied to the buyer part of the due diligence process. But and we'll talk about this later on. There's much more of a focus now, especially from our end when working with clients to advise them to think about a QoE or quality of earnings pre-market, pre-sale. So a quality of earnings is essentially a financial X-ray of your company's profitability. It's prepared by a third-party independent firm focused on normalizing earnings, normalizing EBITDA, and general financial accuracy. So every deal, a QoE will be usually applied, but normally it's by the buyer during a due diligence process to make sure everything we're telling them resonates and is true and all buttoned up. It does reconcile, everything around the financials, around invoices and payroll and talking to the C-suite to make sure everything aligns. It tests for cost savings, sustainability, whether or not seller has inflated expectations for growth or earnings or financials as they see. It looks at revenue quality, recurring, non-recurring, customer retention, a customer concentration, applies all of that, and it also assesses working capital. And working capital, kind of net working capital workouts will be done toward the end of that due diligence process to make sure the buyer is comfortable that there's enough working capital in the business that will continue to meet its obligations over the next 6 to 12 months, right? So things like that, really, really important. So QoE is very a technical process, but something that will happen for the buyer during due diligence, but as we'll talk about later, is definitely something we should be recommending pre-market so sellers and business owners have an expectation going into that process, right? What's beneath the surface of these financials? Will buyers be very certain that earnings are real and repeatable and accurately represented, and that those adjustments and those add backs are appropriately accounted for? And that's what it really comes back to. And so you'll have third-party firms to be able to verify that. So what are they looking for? All of those things, of course, consistency, how to verify, the reconciliation of all these things. They're going to dig into those financials. They're going to ask a lot of questions. Obviously, you want to connect them with your CPA or bookkeeper going through this process. But when you talk about add backs and adjustments, it all needs to be reconciled and accounted for. And again, the cleaner we are going into this process, the easier it's going to be. Many, many times, a majority of the time, post-QoE, okay, and that report comes into the buyer, and there's pushback, right? Or there might be some things that are inconsistent. So normally we need to expect there'll be some kind of haircut. At the end of that process, the buyer will try to apply to the deal. Haircut for add backs or adjustments or EBITDA, which obviously impacts your valuation and potential deal. Not always, but it does happen. And so we want to try to prevent that with preparing in advance going into the process.
Jeff, is there a size of business that's, let's say, too small to do the QoE? I know we're largely talking about the 5 million EBITDA plus type companies or the add-ons or things that are maybe in a more sophisticated arena. But there's a business owner out there that, let's say, is a smaller business. What's your take on that?
Yeah, smaller businesses are usually going to have a larger portion of those adjustments, in adjusted EBITDA, and so they'll be doing a lot more pass-through expenses personally. So yes, I would say we've represented add-on scenarios that are as small as $1 million of EBITDA, Tim, and the QoE is significant. It's still applied on the buy side. And so again, as a business owner, taking advantage of those pass-throughs, something smaller than $1 million in EBITDA, I still think you should informally investigate this. yourself as a seller going into the process. And again, it doesn't matter because if it's $1 million of EBITDA and you still might be getting 5-6 times, right, for value, $100,000 to $200,000 adjustment, Tim, is significant for you.
Very
So,
significant.
let's do it. Let's do it.
Hmm.
And just to add to the importance of the quality of earnings, the last letter of intent, essentially offer on our client business, and very good example of how these are usually structured. The last offer is the valuation is based on the adjusted EBITDA after quality of earnings.
Yeah.
Okay? So this alone explains how important that is, right? You get an offer on a number and then that number changes after quality of earning. It might be the same multiplier. The valuation is going to be very different. So the importance of doing the quality of earnings, the importance of doing an informal quality of earnings before approaching the exit, also very important.
Yeah, no surprises, right, Antonio? And to your example, that's when all these deals break down, right? That's when they blow up. Is that last mile retrade based on the evidence of the QoE or anything that due diligence they're doing? Not good.
Just a couple of words on the buyer's perspective, right? We talk a lot about the seller and the operator and the importance of doing things, but how do private equity groups or corporate buyers approach this? They have to deal and understand and evaluate the same add backs, right? Those are the same expenses, the same calculations. Their mindset, in my experience, is that they have financial statements audited, reviewed. That's their starting point, and then they are trying to understand what expenses are disappearing after the acquisitions, but what other expenses might arise, right? And determine the true profitability of the business in a context, in a post-acquisition, under new ownership potentially, right? And that is important because it represents the true value generation of the business from a financial standpoint. We talked about the typical concerns, but to reiterate, when they are add backs are a large chunk of the adjusted EBITDA, right? 30%, 40%, 50% or more, generally doesn't mean they're not going to get approved, right? There can be an explanation for everything, but the buyer will start looking at the transaction with a bit more attention and care and understanding. Are these add backs going to hold during the quality of earnings, right? Or am I potentially wasting my time if I'm putting up an offer and everything and some due diligence expenses in a company that will turn out to be a much lower profitability than the one presented to us, right? Very typical thinking.
Yes.
And then one last consideration is about the distinction or fine line between the add backs and the synergies, right? We talked about add backs at length now. When you are in the process of being acquired by a strategic buyer, there are usually some synergies, at least on paper, right? I think Jeff is also going to talk about this, but my perspective is that the add backs are expenses usually that shouldn't be there, right? That the seller is taking credit for, is getting credit for, whereas synergies are anticipated value creation that results from that specific buyer, right? And in part, it's the seller that uncovers them. In part, it's the buyer. Everybody benefits from that, right? Because they usually lead to greater top line sales, cost savings, margin improvements, right? But they're a little bit different from the add backs, right? It's a little bit hard for a seller to present the bill for all the forecasted synergies that will be achieved. So just want to throw it out there because we see all sorts of things when we work with operators.
That's an excellent point.
And that's when negotiations happen, right? So on the next slide, Antonio, this is a big part of the conversation. So coming back to synergy and strategic thinking around add backs, you got to know your audience. So for example, financial buyers, they're going to be most concerned with the cash flow, durability of the business, fundamentals. Strategic buyers, as Antonio pointed out, they're going to be more selective around the synergy alignment. of that potential asset and acquisition, right? So you have to understand the buyer sentiment and just generally accepted market expectations for both types of buyers. And yeah, I mean, at the end of the day, those strategic add backs, it's going to be hard for sellers to make those big assumptions, and that's what due diligence is for. And to be on the seller side here, there are also add backs or cost savings or overlap capabilities or redundancy that the buyers will uncover, and which is part of why they want to acquire the asset in the first place, but not give credit back to the seller for that. And so this is why you kind of do some reverse due diligence, and buyer and seller need to be able to meet somewhere in the middle on these things. But from a seller perspective, understand where you go into that process, who you're talking to, and what they're most attracted to about the business, what's most appealing to them, first and foremost. But again, we don't want you going into the process with overreaching assumptions on add backs that cause problems, right? Again, this is much just about the relationship as it is about the numbers in the deal. But when you're claiming cost savings, and there is some redundancy or overlap with the buyer, maybe some of their systems, some of their operational workflows, whatever that might be, customer overlap, right? So you got to show that over time when they it might be implemented, how far do they go, right? So we can defend those to that buyer during the process. But again, this is what due diligence will uncover for the most part, and that's seller and investment banker job to be able to defend that going forward when you present that strategically to that buyer. So this is part of that artistic science that kind of the deal making process is all about. And can absolutely impact the deal, not just from a valuation perspective, but closability, right, to get something done. So very, very important.
We prepared a few real-world examples from companies that have approached an exit that we help to sell, or they're in the process now. Pick one thing out of each example, but you'll see different companies in different sectors with different size, with different add backs, and I would like everyone to pay attention to how they look, how they fit, the consistency aspect that Jeff talked about, the line items and how much they represent of the total. So there's 4 examples. They kind of go from simpler to more complex, or with more discussions around it. So let's briefly go through each of them. Metal fabrication company, the add backs are in this case substantial. You can see in 2024 there is over $1 million in add backs, much different amount than the other years. The bigger thing impacting the adjusted EBITDA here is a project that the company started in 2024 or at the end of 23. A project that was then discontinued, and therefore it led to no revenue, no sales. It didn't appear in any of the other years. And therefore, the business is claiming, look, both the R&D and the personnel associated with that, we want to carve it out to represent the true profitability of the business. And I believe that it needs to be obviously backed up and explained, but that's consistent with the logic that we went through. The other thing is there are 2 owners. This is a very frequent scenario. One of the owners will retire, will be replaced by a current employee taking that role, maybe with a bit of a salary increase, and therefore that owner compensation there is the part of the payroll that is going to disappear after the transaction. Okay, fairly straightforward. Now, in this case, it's a larger company in the industrial distribution. Here we also have a dynamic, a family that is, not only running some expenses through the business, which is a residual part, but actively working in the business for some members, and just more inactively working in the business. And as the buyer is looking at this, there will be changes in the management, right? And so that current management owner salaries, which represents $700,000, $800,000 per year, is really the difference between the current management payroll versus the anticipated management expense, right? And so we're only carving out what we expect that will be redundant. And then the rest is, some severance, which is one of the categories that we talked about, as well as some one-time expenses, in this case tied to the hibernation of a branch. Now,
And we see that a lot with family businesses, right, Antonio? This is a common thing.
yes.
Yeah.
Yes. This third example, you see there's only one line item here, but it's quite chunky, right? It increases the EBITDA essentially in 24 from 2.3 million to 3 million. And then in 2025, the impact is even greater, essentially bringing it from 3.6 to 4.6. What is in there, promoter withdrawal, in this case, these are expenses that are all associated to payouts to the one owner of the company that are flowing essentially through other entities or related parties. This is a business owner with several companies and individuals associated with him. Again, some of the motivation might be around tax mitigation, right? Being efficient. Now, the question here, given the entity of the add-backs, is verifying that behind the services there isn't, behind those add-backs there aren't services that were provided, verifying that post-transaction those will essentially not repeat, right? And again, normalizing the adjusted EBITDA. So simple, but as we wrote, the devil is in the detail. And that's what the quality of earnings will verify.
Yeah.
Now, this last example is one that led and will lead to more questions, right? There's a lot of items in here, but the first thing you see is that the EBITDA before the adjustments is, in the current year is almost a break even at 0.2. In 23, it was a negative EBITDA. It was a relatively low EBITDA in 24, but after the add backs, we land at 10, 11%, 8% EBITDA margin, which starts to be a very encouraging and good EBITDA margin. As you dig deeper, you can see that there is a lot of things that might request for clarification or lead to questions. For example, again, the owner's salary and employer taxes. Well, who do they refer to, right? There's no commentary here. So I know there are two owners in this company. Are we thinking about a scenario where both owners are disappearing from the business? Who's going to replace them, right? Is the buyer thinking about, not needing that type of G&A function because they already have one, or is it something else? Maybe only half of that add back is going to be justified. There's bad debts for quite a bit of money in 24, but bad debts in many cases are normal in a business. Is the cost of running the business, right? So unless they are tied to an event that is a one-time event that is not non-recurring, those are probably going to struggle to stay as add backs. In fact, every year you can see in this P&L that there are bad debts, right? So they already show they're not really non-recurrent. And then other things that, if we had more time, we could pick and discuss. But the point here is we're not saying that these are not valid, but everything needs an explanation. They need to be reasonable. They need to be justified. They need to be true, right? And most importantly, once you get to a quality of earnings and due diligence, everything is going to be verified and discussed. So good to get ahead of it.
Yeah, and we want that process to be as smooth as possible. So as you guys can see, these examples are all different scenarios. But again, the burden of proof resides with the seller. And so, we generally think about this, again, from a pre-market perspective, where you as the seller can get ahead of it, can get prepared, so your expectations are hopefully met. And so We've said this 100 times through this call. It's consistency, tracking, documentation is critical to be able to verify these things. We highly recommend pre-market Q of E analysis. Now, that doesn't mean you go out and get a formal Q of E report. That's not necessary. What is necessary is to understand what those adjustments look like for your business, and then will those adjustments be accepted in the market? And then from there, baking that into your financial, forecasts, historicals and forecasts, and determine what that true adjusted EBITDA mark might look like, so you can go to market with a valuation expectation that hopefully is met or at least close to, right? So there are firms out there that will do this. We do a lot of this work as well within our investment banking practice, but it's most of the time, like 99% of the time, we talk to potential sellers and they're not even doing this. They're not thinking about this. And so getting that to go in advance is critical. And by the way, that still will not prevent the buy side from doing it on their own, which they will, but at least we know what we're getting into going into market. Okay. The third point is huge, and Antonio just illustrated this with the last 4 examples. It's bake that adjusted EBITDA line item into your annual financial model, both historically and forecasts, right? Include an itemized assessment of what those adjustments are, right? Let's be transparent. Let's get ahead of it and verify and track all of those along the way, because I promise you, whether it's a strategic buyer, financial buyer, when they see that itemized the right way, the difference between adjusted and EBITDA and normalized adjusted EBITDA, it's going to make the process happen so much more quicker and smoothly. And also, again, getting full credit for what you've put down, but also get to an enterprise value that again is met with your expectations. And finally, as we always say, build your M&A team in advance, right? Your CPA, your tax attorney, investment bankers like GrowthInc, of course, GrowthInc Capital. This is what we do. And so preparing you for market is just as important as being in market through the deal making process. And that's the idea here. And this one specific topic today really drives a lot of that conversation. So we can't, it's extremely serious. It's something that needs to be prepared for. And very easily having that conversation to uncover these things, looking at your financials months in advance, is not hard for us to do. So we highly recommend going through these steps, and we promise you'll be better off for it when the time comes to exit.
Jeff, you had mentioned in the past that one of the fastest ways to add value was through running an auction process.
Yeah.
And it looks like one of the second fastest ways to do this, or best ways, is to going through this add backs exercise. I would say maybe the third on that is building your M&A team and making sure you have some sharpshooters in the fold.
Indeed.
If a person, I'll close it out on this. If an individual is firm on their add backs, they know what qualifies, what doesn't qualify, they've built a team, they have the QoE, they got GrowthInc in their corner, and they have a good solid business on the hand, what does their future look like?
Well, the future looks like we could maximize value. That's the idea, right? Is to go through this process to maximize value, get the deal you want and the partner you want. And if all of these things are covered going in, Tim, the likelihood of that happening increases exponentially. That's the future. Yeah.
Wonderful. All right. Well, we'll put contact information in the show notes. If you're new out there, please like, comment, subscribe, follow, tell a friend, and we will see you on the next one. Thanks, guys.
Thanks, everybody.
Thank you, Tim.
All right, thanks.
Bye.